Okay, so that's the difference. Now, again, for discussion here, can we just assume that they're calendar year? That way I won't have to disclaim it every time and say, now that's only for calendar year companies. Because I want to use some timing in here. And if you'll turn to page 4.4, let's discuss a company. And this is a no-name company. It's just to understand this year-end processing that goes on. We have a balance sheet or a general ledger. We got the balance sheet accounts on the left-hand side. We've got the general ledger income accounts down the right-hand side in T account form. Okay? Now let's look at these numbers for a moment. Looking at the balance sheet, this company has a few assets, furniture being the only fixed asset, right? A few liabilities. They have the capital account. What type of legal structure is this business? It's a corporation. How do we know that? It's got retained earnings. It's got capital stock. Those are corporate accounts, okay? There's one other thing that I'll point out secondly, and in a few minutes, that shows that it is a C corporation, okay? And we've discussed this before. Now, looking at retained earnings, there's no balance in retained earnings. What does that tell you about this company? It's a brand new company. Haven't finished a year yet. So they're in their first year of operations. It may have been 12 months. This may be the 12th month. Maybe they started on January 1st. We don't know. But in any event, this is the first year of their operations. Now, looking at the income statement or the income accounts, we have two different sales accounts and we've got two different cost accounts. Calculate the gross profit for me real quickly. What is the gross profit? Not net profit, but gross profit of this company to this point. $100,000, right? We get that because we've got two sales totaling up to $300,000, right? And we've got two costs totaling up to $200,000. So we've got $100,000 in gross profit. Now that $100,000 is an accumulation of however many months they've been in business. If they've been in business for 12 months, that's about $8,000 a month in gross profit that they have earned. Okay? The expenses are also an accumulation. So they have spent an advertising expense $10,000, approximately a little bit less than $1,000 a month so far. So it accumulates that through December they have spent $10,000 on advertising. We arrived at these numbers on what date, do you think? When did we physically come up with these numbers? Do you think we stayed worked December 31st and got all this together? No, I was out partying. Okay? Yeah, no, you wouldn't. So December 31st, we didn't have all the information by December 31st to do this yet, right? We need to have a bank statement. We got to have all that stuff. So when do you think we actually did this? Yeah, January 6th, 7th, something like that, right? Now, I want you to make that, or just note that in your mind, because that's going to be important in a moment when we're talking about this 13th month process. It didn't happen on December 31st. But what we did is we accumulated all these numbers the same way we had the previous 11 months, and we prepared a balance sheet and an income statement. And the income statement said that after subtracting $60,000 in expenses from $100,000 in gross profit, we got $40,000 in net profit. And that is our 12 months earnings number, okay? That's how much income we've got to this date. Once we prepare that financial statement, we start the 13th month process, okay? And that 13th month is a separate reporting period that we use to isolate year-end adjustments. Once we do those, then we're going to create a new set of financial statements that we call the final year-end financial statements. Now, businesses do this. Both big and small businesses do this. Now, this company, on the facing page, page 4.5, we have a series of adjustments that this company has decided to make. Oftentimes, you might look at a company and look through those financial statements at the end of December and say, you know, these look perfect. There is nothing more we need to do. In which case, the 13th month will consist of one closing entry and you're done. So again, it could last as short as 5 minutes. It may even be less than that because today with computers, oftentimes it's just an item on a menu. You select it and it's automatically done. okay? The entries made for you, so it could be microseconds. Okay, but let's go through each of these entries, and as we go through them, I want to address some of the issues associated with these entries. So I'm going to take off on some side canyons with most of them, just to help you pick up a few little tidbits or gems of information while we're doing it. The first one was to adjust inventory to physical count. See, on December 31st, we took a physical count. We found out that this inventory was actually $52,000. And so we need to write it down, 4,000, because it's not, I mean, look at what the books say. What do the books say? 56,000. It's actually 52,000. So we need to make an entry to reduce it $4,000. So I want you to go, the counts are provided there just to save you having to write them, but I want you to take a shot at which is going to be the debit and which is going to be the credit for $4,000, okay? And there's a 50-50 chance of being right. Very good. Debit cost number one, 4,000. Credit inventory, 4,000. That will reduce the inventory account, won't it? Down to 52,000. That's where we want it to be, okay? Now, there's an issue associated with this. There's a couple issues. First of all, when did we know that the actual inventory was $52,000? Yeah, when we did the physical count, right? So maybe January 1st, January 2nd, when we did the tabulations, it came up to 52,000. When did we prepare these December numbers? January 6th or 7th, right? So already when we prepared these numbers, we knew that the physical count was 52,000, right? Why didn't we adjust it in December? Why did we wait until the 13th month to do that? Well, to understand that, you first have to know that in calculating that 56,000, we were using an estimate, okay? We were using a percent of sales to calculate the cost of sales. And so we were drawing out of inventory a guess, an estimate of what we actually sold, right? So that 56,000 was a result of that estimate. So why didn't we take the adjustment back in December? Anyone want to guess?
We hadn't done the physical count?
Yes, we had.
Oh, we had.
We had done the physical count when? December 31st. We had it done on January 2nd. When did we do these numbers? The 6th. So we knew the numbers. We knew $52,000 before we did the numbers. Why didn't we adjust it in December? The reason why is because when did this $4,000 discrepancy occur? Did it occur in December?
We don't have any idea.
It probably occurred throughout the year. Maybe a little bit every month it occurred. Now, if we had taken that $4,000 reduction in earnings in December, what would it have done to December's income? It would have lowered it by $4,000, right? Isn't that a little unfair to December to say that that $4,000 all occurred in the month of December? So what we did is we calculated December the same way we had calculated January through November, so that it was consistent. And we waited to make this year-end adjustment until the 13th month when we could isolate it in one reporting period. Okay? So that's the purpose of the 13th month, is for that isolation, okay, to make these year-end entries. And you'll see that again and again.